sir.
दिख नहीं रहे हो वीडियो देखो जरा सा एक सेकंड मैंने आज ही अभी हाँ भाई पहले तो बहुत बहुत हैप्पी बर्थडे
सर
हैप्पी वेडिंग एनिवर्सरी
थैंक यू सो मच
चलो गुड अच्छा है अच्छा लगा क्या बात है पूरा सब
इट्स अ डिफरेंट लुक
चलो हेलो
yes ma'am
हेलो
I think we have very few moments left to start. Thank you all for joining. Since we have this interviews lined up starting from Monday, what I have thought of that instead of interacting one-to-one with all, I should be actually interacting with everyone, at least on the common points. And if there is any queries, we can discuss one-to-one. So I think the basics that I would like to cover in next 40 minutes, because Zoom has this requirement that meeting will log out of after 40 minutes, is to give you a broad overview of what has happened in terms of policy developments in last 1 year, especially after COVID, both at the government level and at the Reserve Bank level. This will give you a base to think of what kind of questions one can expect, because mostly it is about what is pressing on the minds of interviewer, and interviewers are just like us, also human beings. I hope I'm audible to all.
Yes, Lee.
So interviewers are also like that only. So whatever is on the current talk of the town, that's what dominates our mind. So it's about what has happened in last 1 year. Let me just focus on that. And the second part I will come to about bank, especially bank. What is the SWOT, strength, weakness, opportunity, and threats, and how we envision to take next 5-year journey as per our vision document. This will give a kind of an anchor how to relate things, what is happening at the macro level and how micro is positioned. And then if the time permits, we will have another session after a 5-minute break from the first session. We'll share the link in the mid-frame, where we can have questions one-to-one if anybody has follow-up questions on the first part interaction that we had. So let me start with this, the first requirement, which is about, if you just take 12 months back, if you go just 12 months back, what was happening? Now we were kind of in a comfort. We were thinking that economy is improving after a long slowdown that we had witnessed. Almost about 8 quarters of quarter-on-quarter decline in economic activity was happening. From 8% growth, we had fallen to around 4% growth. And that was the context wherein this COVID happened. So policymakers were already in kind of a commodity mode. It was not a surprise from them to keep interest rate at low. The only comfort that we had this time around, vis-a-vis what happened in 2013 or what happened in 2008-9, was that at least at the external perspective, macro stability was in our favor. So when we say what is external, it is about, first is about whether you are able to finance your current account deficit. So you should have sufficient inflow of foreign currency. That gives you comfort. Second, it is about whether you have a inflation which is higher than the rest of the world. And if it is too higher, then obviously trust in your currency, trust in your bonds, that all goes away. And which becomes again a kind of accentuating the decline. So this takes the policy priority. Thankfully, this time around, even if we had a growth decline, the external situation was comfortable. You have no worry on the balance of payment part, and you have no worry on the inflation part. So both negatives, one external, one internal, both were at least not a pressing worry. The only thing was that growth was not picking up as much as policymakers would have wanted. So what happened in response to COVID is that first it was thought of as a health crisis, and it was a health crisis. The challenge was to kind of spread the contagion to a level, or moderate it to a level where our systems can respond. And then if it permits, we could have thought of a kind of giving a revival effort. Somebody else is joining, just give me a second. Yes. So they're on. So if you look at from the policy perspective, what has happened, it is mostly about ensuring that you don't lose your way for the want of funds. So the government's first focus was that those who were vulnerable, like poor, migrants, you will say farmers who are dependent, first to help them tide through this emergency. So the first part of government support, which came somewhere in March, late March, what we call Pradhan Mantri Garib Kalyan Yojana, that was more about giving them respite in the interim. And the first response which come from Monetary Policy Authority was also even kind of a pumping sufficient liquidity in the market. It was less about making cost of capital coming down and more about giving a trust that though there is no shortage of money in the system, whosoever needs will get it. So that was the emergency response. That was the first stage of crisis response that we had. Those who are not, just support them enough so that they tide through this. Now, I mix both because things happened, I would say, simultaneously. It's not all that the fiscal policy was happening in a parallel universe, monetary policy was happening in a parallel universe. Both were working in sync. So when you have a situation where demand is disrupted, and when you also have a situation which warrants supply to be disrupted, supply was disrupted because you had to opt lockdown. So lockdown was most stringent by all measures. In terms of allowing kind of unemployment allowance for those sections, or incentivizing the employers who could kind of keep on them on their roll and instead of laying them out. And what was that incentive? The incentive was that government will pay for the PF part of their contribution. So employer contribution will be borne by government, and employee contribution also will be borne. So for a 3 months period, this was the emergency provision for keeping people in loop. Now, if we go by sequence, I will just come on the measures that were undertaken, policy response in terms of when we had this unlock announcement, which was roughly about 15th of April, and thereafter gradually it was in June and July and August. So government kind of positioned its stimulus, what Atmanirbhar 1, Atmanirbhar 2 and 3 in sync with the opening of economy. So Atmanirbhar 1 was mostly about supporting kind of MSMEs, so that MSMEs don't have, I would say, deficit of funds. And the part of the package was that emergency credit linked guarantee scheme. So it was envisaged that 3 lakh crore of capital liquidity will be provided to them. Of course, banks were kind of difficult to promote that. And the second part was about those who had lost their equity component in it, or they were too leveraged to get new funds, kind of providing them quasi-equity. So there was also a subordinate debt scheme of 15,000 crore fund which was launched, part of this scheme. There were parallel developments in a sense that the other sectors, vulnerable sectors, there was measures for agriculture sector, and both were intertwined in a sense that you have structural measures as well as emergency measures. So structural reforms in agriculture sector came. Of course, we all are aware what is happening on this free farm legislation which came. These are mostly post-harvest interventions which were desired from long time but was not kind of implemented. So what are these? The first one is that you should have the ability to sell your produce to whatever market you like. So the APMC Act was amended, which gives them freedom to sell your produce out of your local APMs. The second was that freeing private participants to store, regardless of this essential commodity restriction that you can't store certain commodities beyond a point. Now, this allows private participants to get into investment into agriculture sector. So, and the third one, if you could mute your mic, whosoever is on there. And the third one was about helping kind of farmers have a better realization. Just a second. Someone else is joining also. Let me help. Yes. Helping farmers have better realization of their produce by entering into a contract ahead of sowing season. So the contract farming also became part of it. Now, at what scale should it be practiced? This is what something was apprehensive. So these were three structural interventions which were appended with the emergency interventions which came for MSME sector. Broadly, that was the Atmanirbhar Bharat package part 1. 2 and 3 were more about incentivizing consumers to buy more. For example, LTC spending was allowed for government sector employees. So not I won't say this was a very significant measure, but then other measures like when you have this production linked incentive scheme. Now this was more about giving India's manufacturers a chance to compete at global level. In export markets, what happens is that if your margins are not good enough, you lose market share. And India's overall competency is not very high because cost of production is high here. You have a transportation cost which is adding up kind of a quarter of your cost, and then you have other uncertainties in terms of support which is required for post shipment. So the two together, there is a way out. Is that government says that okay, you produce and sell, I reimburse part of your revenues, which will add to your margins. So that is the production linked incentive scheme. It kinds of assures an exporter that 5%, let's say 3 to 5% of your revenues will be given you back. In addition to what you have earned, government contributes to 3 to 5% of your overall revenue, and this becomes a kind of another trigger for manufacturers. It started, mobile manufacturing in India, which was given in early April-May period, and now it has been extended to 10 plus sectors. It is hoped that over next, I would say, 5 years, India will have kind of manufacturing output because of this scheme, more than $550 billion, which is roughly, I'd say, it's kind of adding 1% of GDP over next 5 years. So this is not a small incentive scheme that we are talking about. So when you have questions like what is production linked incentive scheme, you just be very sure that this is not run of the mill routine scheme. It's one of its kind because it covers a very gray area. The gray area is that even if you don't have a realization to the level that you expected, if you have investment of a certain threshold, that's 100 crore and above, you are eligible for that. And if you make that realization of revenue happen, your cost of your margin of business goes up. Both ways you are a winner, and this is what actually is happening while manufacturing. Most of the beneficiaries have said that this has been a kind of a differentiator for them. So these are the broad, I would say, government interventions which were warranted. One was about ensuring there is a immediate relief for the vulnerable section of society. Second was about helping them avail liquidity and kind of quasi equity. And third one was about help them become more competitive. This summarizes the approach of government to this COVID crisis. I'm not covering the health part of it. It's known to everybody what has happened. But on economic front, what was the policy priority? Meanwhile, Reserve Bank of India has also kind of several initiatives which were both in sync with government and its own parallel central banks. So what happened is that starting from March, Reserve Bank started reducing its rates very significantly. Repo rate came down by somewhere around 115 basis point, and reverse repo came by 155 basis point. So from about 6%, we have come down to around 4% and 3.35%. It was a huge kind of response. And then you have this long-term repo operation. So this is something which I'd say who is not directly involved into Reserve Bank's working may have confusion. So repo is a rate at which you borrow as a bank, borrow from Reserve Bank of India, and reverse repo is a rate at which you keep your surplus liquidity with Reserve Bank of India. So the long-term repo operation was different than repo in terms of that in repo you are just allowed to keep it for one day. Avail it for one day and keep it for one day. For long term, it's about 7 days to 52 days. And there was another dimension added to it. Instead of only 52 days, which is term repo, now they say that you can keep it for next 3 years. So if you have the fund access for 3 years, or you can deposit for 3 years, what it gives you flexibility is that if you lend to somebody out there, let's say MSMEs you are lending to, or the target sector NBFCs you are lending to, your cost of refinancing has gone down substantially, because from market you were raising around 5.5% or 6% most. From Reserve Bank window you could raise around 4%. That was the incentive at work. Whether it was successful or not is debatable, because there were restrictions on what kind of investments you could take, whom to lend, what kind of credit risk you have to work with. So success can be debated, but as far as the measure is concerned, it was unprecedented, and it was required very much. So if you add what happened from government balance sheet, which is fiscal stimulus, and what happened from Reserve Bank balance sheet, which is a monetary stimulus, take together, you have a stimulus roughly about 13% of GDP. This is when why you needed 13% of GDP, whether it is the by far the best that a government has done is again questionable, because if you take the advanced economies average, G7 economies average, the stimulus has been about 25% of GDP. If you take the emerging market average, the stimulus has been about 6 to 7% of GDP. So India has somewhere in between, about 12 to 13% of GDP, and it is a mix of both. It is a mix of both liquidity measures as well as fiscal spending. So I think the quasi-fiscal aspect is when you have the government guarantee, right? Even if banks were lending under emergency credit line guarantee scheme, the insurance part, underwriting part, the risk part, credit risk part was on the government balance sheet. So you have to take it apart as a part of stimulus. That's what I'm coming to. Then you have this CRR cut, which releases liquidity. Then you have SLR, which was relaxed for a while, and SEBI also joined in. It said that debt default notification, which was that from certain date, even if there is a one-day default, you have to notify. That was kind of postponed, and even there were measures like the capital conservation buffer, which was required to hit from April. It was postponed by 6 months to September. Then again, it was postponed to this near 31st March. So these were measures which kind of delayed the emergency required of regulatory capital, and which helped banks to kind of conserve cash, and which helped banks to execute the benefits which were expected from government side. So in the end beneficiaries, whether we talk of MSMEs, whether we talk of agriculture farmers, whether we talk of NBFCs, whether we talk of corporates, they were able to avail it, because banks were not compelled to do what they would have been in normal circumstances, which is about maintaining regulatory reserves, which is about maintaining kind of capital which is required. So these are the broad contours which were at the policy level which were being contemplated. Government was, let me summarize for last 15 minutes. Government was about to give, priority of government was to give relief to the vulnerable sections first, which was about Pradhan Mantri Garib Kalyan Yojana. And the second part was about to help them recover fast. And recovery phase happened after unlock. So 15th April onwards, when second phase of lockdown was kind of announced, you have this gradual easing of restrictions, and that was combined with the liquidity measures, emergency line of credit, and other government guaranteed things. And the Reserve Bank on its part did it brought down repo rate down significantly. It eased the liquidity constraints in terms of CRR and SLR, and it provides emergency window for liquidity, which was about long-term refinance operations. Now, from long-term refinance operations, there was another addition, which was TLTRO 2.0, and 2.0 was mostly about that you have to new set of beneficiaries identified. So for NBFCs, for example, housing finance companies के लिए there was some provision from government side, and you have fund of fund schemes for MSMEs. You have a special purpose vehicle for NBFCs and housing finance companies, which was fully guaranteed by government of India. So these were part of Atmanirbhar Bharat 1 and 2, and this mostly happened. Now, what has been most significant, and I think the most number of questions can be expected from you, is about the restructuring scheme which was announced for MSMEs. The moratorium which was affected from March on debt collection EMIs, which ended after one extension ended in August. The court intervened, and it says that you can't reclassify your assets as you would have done in business as usual sense. So the court still continues, and it has given a birth of new kind of gray area, which is called potential NPAs or pro forma NPAs. Now, the extent of this pro forma NPAs is quite debatable, because Reserve Bank, when it came with its financial stability report, it says that gross NPA of scheduled commercial banks will rise by very significantly. From 8.5%, it can go up to 13.5%. But when you look at the bank balance sheet and what has been declared as pro forma NPA, it hardly crosses 2% of, taken together, SMA and pro forma NPA. So from 2% which has been reported by banks and 6% which is being forecasted by Reserve Bank of India, that's a gray area where people question who is saying what. And the response is that, financial stability report has data till September. And most of the developments in terms of collection efficiency, which has happened after September, has been quite promising. You have very gloom and doom scenario till September. After September, you have kind of more encouraging numbers flowing in. Whether it is the financial results of corporates or whether it is the bank's collection efficiency, both have been quite positive. And thankfully, the GDP data for Q3, which is printed positive, 0. something percent, it actually validates that things were not as bad as feared by Reserve Bank of India. So the projections in financial stability report hardly have, that much of value. Of course, the stress is there, and we can't be sitting easy. But it is not to the extent that it kind of makes life very difficult. So these are the broader emergency measures that I've talked about. And if you look at what's happened on the external side, because I said that there was no pressing worry. Rupee was not under pressure like it has happened in 2013 when you had taper tantrum. And the taper tantrum was about Federal Reserve announced that whatever quantitative easing is for doing, whatever the bond buying purchases monthly basis it was doing, it was gradually kind of unwind that. So instead of purchasing, it will start selling. It will try to reduce its balance sheet, and that fear actually percolated to emerging market economies. Investors started to exit their positions. They started taking investments from emerging markets to developed countries, and the currencies of emerging markets like India, rupee become a prime target for that, or I would say collateral damage for that. And that time, since you have high inflation, since you have high current account deficit, you could not do much on that. But this time, you were better prepared. Not only that, you have a luxury of fund flows coming in between March last year and March this year. You have your currency, forex currency reserve has gone by $150 billion. Now that's the amount that has been unprecedented, and your rupee has not appreciated to that length. I mean, you are still about $70 to $73 per rupees per dollar. So that differentiation is there. I mean, you had a situation which was unprecedented in 100 years almost. But again, in terms of impact, macroeconomic impact, you didn't see the signs of vulnerability which are usually associated with that kind of crisis. Impact was huge. I'm not saying, or nobody can say that impact is not there, because if you look at what India has lost, it has lost almost 1 year's value. Our GDP forecast for next last year budget for this year was roughly about that GDP will reach to about 224 trillion rupees. And 1 year after, when you came with the budget, your again next year forward forecast is that it will go 223 trillion rupees. So in 1 year, you have actually added nothing, right? Last year, FY21, you have decline of about 5%. Now it is a real decline of 8% and nominal decline of about 5%. And then next year onwards, even if you have a recovery of 10% growth, that recovery is not enough to pull you to a level which you have otherwise reached. So you have lost a huge value. And if you take the IMF data, it says that for 150 odd countries, and a per capita GDP will not come to a level of pre-COVID for next couple of years. For 2 years, you don't have that reversal to pre-crisis trend. So that's the kind of number that we are looking at. So in terms of impact of COVID, yes, there has been huge value disruption, value lost. Unemployment has been there. But in terms of response, nobody expected that, in a period of 2 or 3 quarters, this kind of bounce back will happen. That is the broad macro overview. And I think I've touched a few, points on which you can expect questions. From government side, part of Atmanirbhar Bharat package could be one, and within which the production linked incentive scheme is where you should be more prepared. If you have to align the structural reforms with the opportunity for banks, again you have to be very thought through about that. I just touched about 3 farm laws and what areas they specifically try to address. Whether banks can have a financing opportunity in those, we have to think through. And there is an opportunity, because if private sector goes for storage infrastructure building, then obviously banks will be financing it. Right? It's not just about the marketing aspect of it, also about the storage aspect. if there is contract farming and new set of institutions come in, let's say farmer produce organizations, again you have an opportunity, and it's a huge opportunity. So it's for banks to decide where they are instead of contributing in terms of finance flows, in terms of contributing for the knowledge and tech support which is required. These are the areas where last 1 year's policy developments were quite revealing. From monetary policy perspective, where should we be expecting questions? Is about the emergency liquidity measures which government announced, for example TLTRO. Now you should know the difference between what is happening at the repo and what is happening at the TLTRO level. The components of emergency component of their liquidity adjustment facility LAF, you have at the top marginal standing facility, you have repo, and then you have reverse repo. So I told you that when you have to park money with Reserve Bank, it is reverse repo rate. When you have to borrow money from Reserve Bank window for overnight purpose, it is repo. And when you have a crisis situation where you don't have sufficient buffer of your SLR security, because when you go to Reserve Bank and say they give me money, essentially you have to keep something with Reserve Bank, right? So in repo, what you do, you give your surplus government securities with keep with the Reserve Bank of India, and in turn you get money. But suppose you don't have the surplus, then what do you do? Then you have to kind of you say that, okay, allow me to dip into my SLR reserves. So the MSF, the marginal standing facility, is actually that provision. It says that you can dip into your your SLR securities up to 2% of NDTL, net demand and time liability, and in exchange you can borrow money. But this is very negative, taken very negatively, because it says that you are not able to manage your business well. It says that you can't be trusted to keep, if your regulatory provisions, how to keep depositors' money safe. So no bank or no financial institution actually likes to borrow from MSF window, even though the difference is quite small. You can borrow at repo at 4%, and you can borrow at 4.25% on MSF window, but nobody does it. This is a simple reason. It's a prestige issue. If you go there, it's kind of it says a lot about how you're working. So that's the reason. So that's a question. From Reserve Bank window, you should also be prepared what it has done in terms of kind of deferment of certain regulatory requirements, like capital conservation buffer was deferred, like counter-cyclical capital buffer, that was also deferred. CCB requirement last trans 0.625, that was also deferred. Net stable funding ratio, that was also deferred. So these are the few words which have kind of got prominence because it just came in the previous policy also. So familiarity with these aspects will also help you. And overall, the composition part of it, mix of both policy levers, fiscal policy levers and monetary policy levers. I have 15 more minutes left for this session, and in this, I am going to cover key, economic words that you will be coming across. Sometimes, people are quite blunt to ask you. Let's say, what is the vocabulary for government? So when you say fiscal policy, it is more about using taxes for spending. Someone more wants to add. Using taxes judiciously for spending on priority areas. Now, when you collect taxes, you are efficient if you utilize it for the spending. You don't have to borrow. But unfortunately, for a developing country like ours, taxes don't have to a level where spending can be met entirely. So you have to borrow also. So when you think of fiscal policy, there are three buzzwords which are common and which one should be prepared. One is about, of course, fiscal deficit, which is about total revenue minus total expenditure. The second one is about primary deficit, and the third one is about revenue deficit. So the revenue deficit is about revenue expenditure, and revenues, your routine revenues, that the difference. So you don't have that investment part included in it on expenditure part. And the primary deficit is that fiscal deficit less interest payments. So whatever you have borrowed till date, you have to also service it, right? And part of your tax collection goes towards servicing this debt. So you take out interest payments out of fiscal deficit, you have this primary deficit. So these are the three deficits which are usually asked. Fiscal deficit, revenue deficit, and primary deficit. And the third one, fourth word is about public debt. Public debt is about if you are having deficit every year and you are borrowing to meet the deficit, you are kind of incurring debt every year, and that debt gets accumulated over time because you service only a small part of it. So remaining balance adds to your overall debt balance. So public debt is accumulated deficit. Now the question, or rather, I would say the hot thing to know about is that public debt was usually about 70 to 75% of GDP for India, right? But last 1 year, one, because GDP has gone down by some percentage, and two, because government borrowed extra. It came with earlier estimate about 6 trillion borrowing, and it borrowed more than 13 trillion. So 7 trillion it had borrowed additional. So that also gets added up to existing level of debt. So your public debt to GDP ratio for India for this year could be about 85 to 90% of GDP. Now that's a worrying, because when you say that government is not very prudent, when we say that you are spending, overspending, and fiscal stance will be taken adversely by rating agencies. So these are the metrics one should be familiar about when thinking about how government is managing its fiscal situation. A related buzzword is about Fiscal Responsibility and Budget Management Act, FRBM, right? And for FRBM, you have this target that over 5-year period, you bring down your revenue deficit to zero, you bring down your fiscal deficit to about 3%. So this worked well when economy was on upswing. That's between 2004 to 2007, when you were having all-around growth. Your interest liabilities were lower. Your GDP denominator base was expanding at a very fast pace. So you have public debt to GDP declining. It also worked for a brief period, 2013 to 2018, for example. It was not rising to any level. But from 17 onwards, it has been on rise because growth came down and because borrowing also was quite high. So this year budget, you have this one additional, I would say, start point. They included borrowings which were kind of from quasi fiscal kind of nature. Food Corporation of India, for example, it also borrows, and this was kept on different balance sheet. But it is actually government which is guaranteeing it, right? So these borrowings were now also being included for this year's fiscal deficit. So that's why little number higher numbers we have, right? So the things to remember is that you have three buzzwords in deficit: fiscal, revenue deficit, and primary deficit. And the fourth one is about public debt. Why public debt has gone such a high level? It is because GDP has contracted, denominator has shrunk, and numerator has gone up. Because we are borrowing 6 to 7 trillion additional. FY21 maybe आपने borrow किया 6 trillion, FY22 maybe you are expecting to borrow 6 trillion additional from the trend level. So if you add 12 trillion additional borrowing to a GDP of, let's say, additional GDP of 20, then of course your debt level will go. That covers the government part of it. So I think we have 10 minutes. I think we have 4 minutes, and some of the questions have come up. Some have not been able to listen to me. I'm very sorry for that. So what I'm saying is that the second part, since I've structured this presentation in two parts, because of 40-minute time limit of Zoom, I will share you another link which will give you opportunity to raise questions on what I spoke about, and also I will share about the SWOT part of what I think for Union Bank of India is strength, weakness, opportunity, and threats, and how Union Bank's vision is actually about building on those things. So this will be in the second part of it. We'll have 5-minute break after 3:40 to 3:45. We'll again resume. Those who are interested can connect back, and we'll have a question answer session also. If I think 3 minutes remaining, if somebody want to get clarification, more than welcome.
Hello.
Yes, sir.
Sir, can you explain what is the accommodative stance of the recent RBI monetary policy? They have said that accommodative stance will continue.
So it is about there are three words used: hawkish, neutral, and accommodative. So when you say accommodative, it says that liquidity, overall money available with banks, will be surplus, right? But you have more money to lend. You not only just you can service your regulatory requirement, you can lend even at a lower rate. You are not crunch with resources. So that is the accommodative distance. Neutrally says that overall deficit in the system will not cross 1% of deficit level. And when it's a hawkish, it says that liquidity will be reduced to a level where you are kind of compelled to borrow from Reserve Bank window. So these three are stances of Reserve Bank of India.
Okay. Thank you, sir.
Sujitji, can you explain what is the quantum of primary deficit and revenue deficit for 2021?
Sir, overall, if you look at the budgetary numbers, roughly 7% of GDP is what fiscal deficit which is expected. 2021 it will be about 9% something, 9.5% something GDP fiscal deficit number. What is material to know is that bulk of it is revenue deficit, because capital spending part only 1/10 of overall spending. So whatever you borrow, you spend on revenue expenditure. I can share the exact numbers of budget in the second part. I don't just remember the exact number, but this is the overall.
Okay.
Vipan sir has raised hand. I think it will log out now. In the second session, I can get back. That's the restriction on Zoom.
Yeah, Sujit, just one thing to think about is what are the things you may think that in terms of the new things that the government is likely to bring in terms of labor laws, even the farm laws, some high-level highlight on that would be helpful, of course, in the second part of this session.
Yes. I will take.
Sujit, one question. In terms of fiscal deficit numbers, do you think that the numbers are really justifiable, or if not, then what are the potential risks to fiscal deficit numbers for the current financial year and the projections going forward?
Okay, we'll take note of it.
Thank you.
Yeah, Sujit, fiscal deficit 9.45 lakh crore already surpassed by the government till November 2020, which is already 135% of their estimated budgeted expenditure fiscal deficit. So they have already crossed their fiscal deficit more than that, and expected it goes to 13 lakh crore approximate in current financial year, as per government estimated data.
We'll come back to it, not so significant. Usually that has been the pattern. In the first half you have more deficit, and second part you try to bridge that deficit. You have more revenue accumulation also.
Should we log out or wait, Sujit?
I think it will log out because that restriction is there. I will just share another link.
Sujit, one more question on the run thought. See, one question always comes is, let us say, for example, defense budget. This is a random, you can take for anything else. But because I remember you said that 6% of GDP is being spent or something like that, let us say. But the challenge is actually the government has only so much pie. But in terms of pie, if you see, they are spending 15% of their total revenue of the year, which includes the borrowing and tax and other things, or planned borrowing. So what is the relationship between both of them, and how it should be seen in good light? Probably this is a confusion that always comes up, especially when we say in education, for example, we say that India spends about 2% of the GDP GDP is the whole nation's net income or something like that. But the actual money available with the government to spend is only about 15% of GDP. Correct me if I'm wrong, right?
Yes,
or it's more
than that. That is the number. Actually, you have taken center and states together. Otherwise, for center, it's just about 10% of GDP.
So it's about 10%, let us say. So 10%, so essentially meaning that even if they say we spend 2% on education or 6% on defense, it means that we are spending about 10 extra, right? And I don't know, you said 10%.
Yeah, 10% of GDP, and you borrow about. I will have actually a separate conversation with you. It's a very exciting area, but then it doesn't serve your interview purpose.
Thank you.
So I think we are reaching to the limit. I don't know whether Zoom is closing off or it is continuing.
Yeah, we can actually close it ourselves and come back again. Why wait for that to be throwing us out?
Yes, please. Thank you.